Well, maturing commercial real estate debt is set to peak at nearly $1.3 trillion in 2027, according to S&P Global. And the industry is facing a refinancing reality check with interest rates still well above pre-pandemic levels. For more on CRE in the year ahead, Peachtree CEO Greg Friedman joins us now. Greg, great to have you here on set.
Yeah, thank you for having me today.
You say 2026 is an inflection. In what way? And how sharp is that inflection going to be?
Yeah, definitely. So going back 3 years ago now, they were talking about, survive to 2025, which now we're past 2025 and we're in 2026. And I think it's now you've got to grind to 2029. And 2029 really just represents the fact that there's not a quick recovery to commercial real estate. It's going to take some time for commercial real estate to recover. But the reality is there's been a lot of extend and pretend over the last 3 years with the banks, which make up about 50% of the commercial real estate debt market, as reported by Trupp. And banks have continued just to extend loans as a way to deal with the issues, with commercial real estate assets. And now you face about $1 trillion of loans just maturing in 2026, which is 2 times the normal amount of loans maturing. And they're maturing at a much, in an interest rate environment that's almost, call it 50% to 100% higher than what they face at origination.
That does not sound like the setup for an inflection point in 2026. It sounds like a big comeuppance in 2026 for the space.
Yeah, so I think it's an inflection point in the sense that finally I think you're going to start seeing assets trade, because the market's been very muted just on assets being able to trade and really recalibrate to this new normal, higher for longer long-term interest rates. And that's where I really see the market being at that inflection point. That it's really not an issue with the fundamentals at the asset level with the performance. It's more of an issue of broken balance sheets. And up until this point in time, I feel like we've just sort of extended out the issues versus dealing with them.
Greg, the market's focused on Fed rate cuts, but in reality, it's 10-year yield and everything out of that, outside that duration that matters. Speaks to that.
That's right. Like the 10-year Treasury is the risk-free rate, and the 10 years double what it was between 2010 to 2022, and that has a very negative impact to the values of commercial real estate assets. And you've seen with just the drop in short-term rates, the federal funds rates, the 10 years remain elevated. It hasn't even come down, and I think that's going to be the case, over the next several years. And when you look at assets trading that have traded over the last 3 years, some of the cap rates are pretty astounding on the low side, just because values haven't fully recalibrated to this new thought process that the 10 years is going to stay above 4%.
So you talked about some of the Class A stuff performing and the business doing fine, might be a balance sheet, but for B and C, which is a different story, particularly in New York, that model isn't working. Do you see a ton of just turnover, that you're expecting a ton of turnover, buildings that have to get sold?
Yeah, so I think, buildings, I think when you look at office buildings, specifically, if you're referencing office buildings, I think the Class A is starting across the U.S. You're starting to see them actually lease up. There's more demand for that space, really driven by the AI trade. I mean, that's helping, get a lot of these office buildings. You're starting to see stabilization on the, really the Class A office buildings. The Class B and C are still challenged. And there's still, there's a bifurcation within the office space that has been taking place over the last year. I think it's becoming clearer now that you have a lot of winners within the office space, where these are assets that should do well long term. You do have some challenges, across certain buildings that probably are never going to recover, just because the Class B and Class C buildings that just lack the right locations, the right amenity set to ever get leased back up.
Greg, help us understand the timeline. It sounds like 26 is this period where stuff is happening, and some of it not good. And
Sure.
So as you're gauging, even for investors watching the show tonight, whether they're professional retail that invest in commercial real estate, and there have been times, again, coming out of COVID, where there was huge opportunities where things were mispriced. And so when's it's not all assets, but give us an idea in 26 when you actually think you're going to start to see some credit events that are going to create blowouts that are going to create buying opportunities.
I mean, it's happening now. We're buying, because we're buying a lot of loans from banks. We bought in 2025, we bought $600 million worth of loans. So the call it $3 billion of loans that we originated, or new debt investments that we made, 20% of that was loan purchases. That was the most that we've done since 2021, going back to COVID in the first half of 2021. We bought a bunch of loans, primarily on hotel assets that were in trouble. And you're starting to see that trade occur now where banks and other lenders are just selling off paper, at discounts.
So you're saying it was $3 billion face that you bought for 600, so trading at 20%?
No. So we originated, I apologize. So we bought $600 million worth of loans that we bought probably on average a 10 to 20% discount off the face. And then we originated another $2.4 billion of loans that we originated they were new loans that we made that were first mortgage loans that financed the acquisition development of commercial real estate assets.